than your currency. Splurging millions, buying houses like Monopoly. Fucking 9 to 5, man, the money is a joke to me. Buying cryptocurrency, my money.
Hey guys and girls, welcome to this week's episode of the No BS with Birchy podcast. I'm your host, Nathan Birch. This is a show unraveling the truth to the start of the 21st century. We're now exiting the matrix and waking up to motherfucking reality. Well, a lot of people are waking up to the reality that the lights have turned on, the music has stopped, and there's a lot of people out there with a hangover now, and not just a hangover of, a big weekend or whatever the case may be, a hangover going, fuck, what have I done? What have I got myself into? This isn't working, that's not working, etc. And that, to me, is opportunity. So a lot of people out there, like today I want to talk about, how to build a property portfolio that's going to be, significant to get you through a recession. And I've always talked about here at B.Invested, building a recession-proof property portfolio. And some people ask me, like, what does it take to build a recession-proof property portfolio? Isn't every property portfolio recession-proof, etc.? So I've been doing this now for about 20 years, 20 years next year. I actually got my first job in real estate when I was 17 years old. I thought I wanted to be a real estate agent, right? And, all real estate agents are successful and wealthy and stuff. And for me, it was the shittest job I could ever imagine because there's a lot of pressures and whatnot. So I actually put a lot of kudos out to real estate agents. But I remember when I was in real estate, it was like 2002, 2003, 2004. It was a very different market to what we have today. So a lot of people nowadays, they don't know what's happened in the past, etc. But I've seen a lot of shit over the years. And I've seen people that speculated at the top of a boom in 2002, 2003, specifically in Sydney. And I'd literally have these like grown men that would have like 5 properties or 3 properties that come in and they rode this propaganda machine that everything's going to keep going up in value and negative gear. And, they've got like 4 negative geared properties and it's costing them, $2,000 a week and they're on $2,000 a week income. And the properties were, they're buying them for $800,000 and they were going down in value and they're only worth $600,000, so they were selling them and losing their shirts. And I noticed this, I witnessed it, right? And I thought to myself, wow, like I want to be an investor, I want to invest for certain things. And that's sort of what motivated me to have, my 3 things about property investing: to buy below market value, have upside for capital growth, and have a strong cash flow so you can ride through any property market. If it's bringing in positive cash flow and the markets go up, down, sideways, well then if something happens to the price, then you don't have to sell it. You can just keep it for another 10 years. You're not forced to sell it. I want to buy it where it's below market value to ensure that when if the market does step back 10% or 20%, well, then I've already built in such a premium that if I had to sell it and I was forced to sell it, then I wouldn't be out of pocket and I wouldn't be losing money. And that's, ultimate thing is to minimize risk along the way from building a portfolio. So we've all witnessed a market recently, right? And these people literally got lucky. There was lots of people out there that got lucky in the last few years that just, they're all experts, all these people out there. They're like, oh yeah, I know what I'm doing, blah, blah. And we're starting to see massive cracks in the system. And the cracks that I'm seeing is people that are building, they're building houses and they're flipping them and stuff like that. People have been speculating that, oh, this property must go up in value. I buy it, it goes up in value, I sell it. Well, if you buy it and it goes backwards in value and you haven't built a plan B for yourself and you have to sell it for less, what is that going to do for you? What is the worst case scenario? And I think when anyone goes out to invest in a property, when anyone goes out there to build a strategy, they should be looking at their best case scenario and going, wow, that'd be really cool, but that probably won't happen. What happens if this scenario? What happens in this scenario? What happens in this scenario? And you want to make sure that in your worst case scenario, you're still making money, right? And that's what you need to plan for. And a lot of people over the last few years have been just like speculating on hype, right? I see it in my area where I live. I see it in driving to my office every day. All these houses that people are building and flipping and, oh, I know how to flip. I'm doing this. I'm an expert. Well, you haven't seen the lights go off. You haven't seen the musical chairs being taken away. You haven't seen, the market change to know that you could get burnt. And I think there is a few people out there in the market that are hurting. And for me, that says opportunity, right? Because you can always go and take opportunity on different things. And that's not because I'm a vulture, it's just that I'm opportunistic and I can give a solution to someone else's problem that they've got. But I think, identifying, right? Like, I'm always very risk adverse. A lot of people think, oh, Birchy, like, he's bought hundreds of properties, he gets in the millions of dollars worth of debt, he must be, flippant with his decision and make hasty decisions. Every decision I make from my investment side of things, and most of the things I do in my life, are very calculated, very educated, very thought-driven decisions that I make to ensure that I'm thinking of, okay, what the future could look like, but I'm also factoring in what happens if nothing turns out. Because in life, a lot of things don't plan out how you sort of expect them to be, and it's working around, if this doesn't work out, if that doesn't work out, how can I protect myself worst case? So a few things for people to consider. Whenever I buy a property, I'm always looking at the things that I talk about. 5 things, 3 of them that I've been talking about for a decade, 2 decades, and the other 2 things which are more recent. So I can keep going through them. Below market value, upside for capital growth, strong cash flow. The other 2, which is buying at below replacement cost and buying in an area where there's upside for servicing, for people to be able to afford to push that price up even higher. And I think a lot of people don't factor that in play, because they think, a house in an area in Kellyville in Sydney at 1.5 million, it's gone up so high. What about when it doubles and it goes to $3 million? Well, if people's incomes cannot support a value at $3 million, it's not fucking going to $3 million anytime soon. We've got to look at what manipulations of the parameters would have to play for that property to double again. So looking at that aspect, I'm looking at getting the stuff that's got strong value to it. The game that I play is between the 50 to 350, 400 grand price range is my foundation property portfolio sort of assets that I buy. And then after you build the foundation portfolio, then add 500 grand, $1 million, like you want unit blocks and large land holdings for that. And then, bigger things up to like 5-10 mil if you have to. But, a lot of people try and, go, oh, I know everything, I've done this, I've done that, and they just add so much risk to their position. Let's say that you buy some properties. I want to make sure that if I'm buying a property that's like 200 grand, rent for $300 a week, that it's going to have a buffer attached to it. So if it's not rented for 3 months or 6 months, if I lose my job, if, the house burns down, the tenants don't pay, whatever, I need to go and renovate it, I need to make sure that, there's enough buffer there to protect it. So having 3 months worth of repayments for it, having 6 months worth of repayments is a very good starting point. I generally make the suggestion of 5 grand per property as a buffer, just to have there in an offset. If you've got 10 properties, that might mean that you've got 50K sitting there. But, chances of them all having a problem at the same time is limited, but at least you know that you can sleep at night and you've got a buffer of funds aside that are liquid for that. I think it's very important to have clear understanding of where you're at, starting off at, where you are at today with your position, and also look at where it is that you are heading, because it's only when you have a clear picture of the starting point and the end point that you can reverse engineer the mode of transport and the route that the route that you need to take in order to get there. So having a clear, defined plan, which is basically like a business plan around your investing strategy, very, very important. So a lot of people will question and say, is it about the location, or is it about the type of property, or is it just completely all about the numbers? And for me, looking at the properties, I'm just looking at the numbers. The numbers don't lie. The property type, the location, they're all emotional decisions that are surrounding that. Naturally, you don't want to go buy in a shithole area. You don't want to buy. Most people are like, I want to buy in this because it's a hot spot. Or I want to go buy over here because it's got heaps of growth potential. Or I want to go over here because everyone else seems to be buying over here and it's going to have a big boom because of X, Y, Z. All that speculation, all that's comfort that make you feel good. When I look at a property, I look at markets and I'm like, that shit's overvalued, right? It's cooked up. The prices used to be able to buy them for 50% cheaper 2 years ago. Why am I going to be paying a top of a market price? It's never been that high before. So I want to know when I'm buying an asset that the numbers stack up. The emotions that you have, they can all lie to you. Your thought, you can sit there and go, oh, I'm the best knowledge and I've done the most amount of research and this is the reason why it's going to go up. Everybody's really hot about that area, hyping up that area. But I've looked at 20 years worth of my investing, and I thought all the thoughts that I had from 20 years ago of buying assets in specific areas because this is good and that's good and all that. People that were buying in these areas thinking they're the smarter person out there buying in the blue chip area, and you look at your position, the numbers were what's important. You can have one property for 500 grand, or you can have 10 properties at 200 grand. If you got 10 properties at 200 grand, that's $2 million. If you got one property for 500 grand, that's 500 grand. If the 500 grand doubles, it turns to $1 million. There's no problem making $1 million. But if you 2 million doubles to $4 million, you just made $2 million profit on that. So follow the numbers. Don't go and get emotionally attached to a location, or this one here, I want to have it here, or all those sort of things. It's got to be a house. Like houses where people get stuck, right? It could be a unit, could be a house, could be a villa, could be a block of units, could be a shop, could be a warehouse, could be a motel, could be whatever you want it to be. The numbers have to stack up. If the numbers don't stack up, see you later, get stuffed, out of here, not doing the deal. So I see so many people that let that monkey on their shoulder or their emotions run and fuel their decisions, and that's where they get stuck. So making sure that your numbers stack up and making sure that the numbers are in line with your plan and with your strategy and your business plan on getting you to where you want to be. I'm sure that when Macca's was building Macca's, someone said your hamburger tastes like shit. Then they go, okay, well, that's interesting. If 50 people say the hamburger like shit, okay, we need to look at that and refine it. But they get their recipe right, and then they scale it on masses. They don't sit there and go, well, I don't like your opinion, I better go and make gourmet burgers and put truffle into the burger and everything to make it more expensive. They're making something economic because it's a scalable business for them. So as an investor for myself, I'm looking at how can I scale my portfolio to make it work for me to get me to where I want to be. So I treat my investing like a business. And if you have a strategy, which is my strategy that I've been using, and it's quite interesting to see other people are now using that same strategy. I've seen people in New Zealand using the strategy. I've seen people in the US using the same strategy. I've seen people in the UK using the same strategy. This strategy wasn't around 10 years ago, 12, 15 years ago, 20 years ago. There was no one talking about this sort of stuff, but now there is, and it's cool, right? We know where the strategy started, but it's important to have a strategy that works to get you to where you want to be. And I feel that too many people, especially in today's market, they're adding their emotion and they're not looking at the risk. People have literally become multi-millionaires. There's so many people out there in this country, like probably 1/3 of the country became a millionaire in the last 2 years, right? And out of that 1/3 of people that became millionaires, they don't know how they fucking got there, right? They don't know that the money was controlled. They don't know that this was controlled. They don't know that it's artificial. They don't look at the risk of what happens if this was to happen here, there, the next thing. So being aware of the risk, being aware of where the left hook could come, it's always important. You want to look at the worst case scenario and make that one of your top priorities, because you're only as good as your worst case scenario. So yeah, looking at that, I think there's a lot of people that haven't factored that in. And I think building a recession-proof property portfolio is crucial, because you want it to be able to survive. If interest rates go up, you want the cash flow to be strong. If the market goes up, you obviously want to have the assets to be able to go up. If the market comes down, you want to make sure that you can hold on to the assets and you've bought them so well that you're not actually going into the red. You don't want to be in negative equity. You don't want to be in under the water with your equity position in your portfolio. And there could be a lot of people out there over the next couple of years that could get burnt like that. For me, I'm opportunistic. I'm excited by that, because I'm like, wow, if there's motivated people to sell, that's the time I want to get buying. I think there's a lot of people out there, and this is going to the next part of, having emotional intelligence, right? Having the emotion to go, wow, yeah, that's great, but not acting on things, right? I see so many people out there that are getting FOMO and just buying shit because they think it's great and they've got caught in some hype and whatever. There's people out there that have jumped in, done things, but they haven't looked at the greater picture. And having the emotional intelligence to, push through that and go, okay, yes, the market's gone up a lot. I'm not going to go and participate in, like, there's no discipline for me to worry about. I'm like, that's stupid, right? Why would I go and participate in a market that's gone up triple, right? I look at the Gold Coast. I was buying the Gold Coast, and people used to laugh at me for 7 or 8 years. I was the largest buyer. I was buying probably 50 properties in the market per month for myself and for my clients. People were like, why are you buying this shit for? It's never going to go up, etc. I said, when the interest rates go down, it's the first market to take off because it's been held back so far. And what happened? That market's gone from 150 grand to 250 grand to 300 grand to 400 grand to 500 grand. I was talking to a mate the other day who's one of my clients, and he said to actually Daniel, my ex-business partner, he said to him, he goes, I've got to thank Nathan. One of the properties he bought me has gone up from 206,000 to over 600,000. That property tripled, right? Now, I know what a lot of people will be thinking, right? And this is where the market's at, right? Is, wow, it's gone up to 600 grand. We'll go buy it today. It's a great property. It's gone up 3 times already. It's like, that's so fucking stupid because the downside risk has never been at 600 grand. That if someone was to trade, that would be a point where you'd want to ditch it, right? And then get out and go to liquid cash. I wouldn't suggest to go to sell anything. But point being is that people get caught up and they're like, wow, it's gone up so high. Let's get in because the market's so high. It might go up to 1.2. Well, the growth has already been had. I want to buy that thing when people are spitting on it, when people are saying shit, when people are being rubbish to it, because that's where the opportunity is. So if we look at the market as a whole at the moment, there's a lot of markets that I haven't been excited about for the last 2 or 3 years because they've been so fucking hot. And I look at the market now and it's like, wow, now there's a bit of fear in that market. That's the time we go and smash them, below the waistline and get the properties at the cheaper price. A lot of people that are just speculators, though, would be fearful. They'll be selling a property. They'll be thinking about not buying a property. They'll be, going into their shell like a little hermit crab, You go and walk through the ocean. You see some crab walking across. You put your foot down in the sand. The crab goes in the shell, goes into hiding. It pretends it's not there. It freezes, right? As an investor, that's the opportunity because you're like, okay, like most people are going inwards and hanging on because they're scared economic, what's their economic future looking like? If you've been smart, if you've been diligent, if you've been strategic with your investing over the last few years, you'd be in a position now where you're like, hang on a second, my rents are going up. Yeah, my interest rates might go up. So what? The property I've got's way below what you can rebuild it for. It's got good upside for growth. It's, doing all its things. It's going up in value still, even though we're in a recession. There's so many markets today which are still in that cheaper end of the market, 100 grand, 200 grand, 300 grand, 400 grand, which are going up. They're doubling. They're literally doubled in 2022, and we're in a recession, right? Because the value is so strong that is there. But there's so many people out there that have speculated without having a sound strategy, that speculated on, not looking at risk and factoring risk into their position, that are now, having to let go of things because they're getting attacked by the market. So you want to make sure that, as you're building this portfolio, you're building wealth and whatnot, that you're factoring all that risk, and you're not going to be one of those people with the weak hands. You've got to have strong hands to go through these markets. So for me, when I quit my job in 2009, I was 24 years old, and I looked at my position and I was like, I realized up until that point, I was building my portfolio based on fear. I wanted to make sure that if the interest rates went up, that my rents were positive cash flow. It wouldn't be an issue. I wanted to make sure that if I had to sell off some properties because I got into a shit spot, well then, I could sell them off and not hurt myself and blow my fingers off. And I factored all these things. That's the only reason why I can sit here with the strategy and say, hey, this is what's worked through good times and through bad times. It's not sexy, not flash, but it's very, very fundamental. I'm not sitting here today with a scotch in one hand, a fucking party hat on, streamers and confetti falling from the ceiling, driving around in the Rolls Royce and going, I'm fucking awesome because, my properties have gone up so high. Yes, the assets have gone up, but that's just a part of the process. I'm not getting overly excited by it. I'm actually not even excited by my portfolio going up. It's just performing its task. It's doing what it needs to do. It's very fundamental for what I need to do to my position to get to the next level, and it's doing its job. So that's what it's all about. So I think having the foundations right, factoring in the risk, factoring the growth, factoring all the elements to the market, this type of market, if you think about going out there And I think to a lot of people now would be scared, right? People watching the TV. I can tell who watches too much TV because they're scared, right? I can tell who's got their own brain because they're like, wow, this is the opportunity, right? Well, everyone else is scared. I can go pick up things cheap. Think about it this way. If the market, which has been going up, let's say the last 2 years, the market's gone up double and everything. Everyone's like, come on, take my money. I'll take away my pest and building reports. I'll take away my finance reports. I'll take off all the terms and clauses that I'd have in my contract just to get a hold of a deal because they're getting caught up in FOMO, hype and fear and all that sort of stuff. People are literally just throwing their money at buying whatever sort of property they can get their hands on because the market's going up. Now, all of a sudden, the market's gotten soft in some markets. Some markets still went up quite hot. People are like, oh, I don't want to buy in the property market. I'm going to wait for it to fall. I'm going to wait for this. Well, that market is a glitch in the system and it won't sit there for too long, right? Are you thinking that property is going to fall 50%, 30%? That's stupid. Looking at that glitch in the market, my thoughts and process behind it is, okay, if there's 1,000 people wanting to buy one property, that's no good. I have no control. If there's no one wanting to buy a property and I'm the only guy out there, my terms will be accepted, my clauses will be accepted, my price will be accepted. I would rather be out there shopping when no one wants to buy shit than buying against all these muppets that want to go and speculate and push my prices up because there's a better opportunity. I want to have control when doing decisions and making deals happen. I don't want the market and other people out there controlling my deals. So that's why I don't get caught up into hot markets. So if you're thinking of buying at the moment, or should you be selling, or should you be, just sitting on your hands, should you be aggressive? It all depends on your position and how you've set yourself up. It all depends on your strategy. It all depends on how you're financially positioned. And I don't have the answers to that, right? Are you over leveraged because you've done some silly decisions? It might mean that you can't do anything. It might mean that you might need to sell something. It might mean that you got to sit on your hands. Have you set yourself up in a position that, you go, okay, now I've got myself in a great position. I can pull the trigger and start firing bullets around? I don't know, right? If you need help on that, you can reach out to us. That's what we do. That's how I help my investors every single day of the week, building wealth in their portfolio. So looking at, the market, a lot of people are fearful. I'm so excited. I've never been so excited as what I am right now because the opportunities there. We've got cheap credit, we've got rising interest rates, we've got rising inflation, and we've got a market full of scaredy cats, right? I'd rather be dealing with all my competition as being scaredy cats. People would rock up to an open home and go, oh, wow, these people want to buy the property. I must buy it. I must own it, thinking that there's some, king because they're buying a property that everyone else wants. That's bad, right? They're forcing my price to go up. They're the competition. They're pushing me to spend more money. They're making me spend more money when that happens. If there's no one's around, it's like, well, I'm your man, right? You want to do a deal today? I don't want to do a deal with you. Okay, well, do you want to do a deal because I'm the only person out there? Great, right? That's what you want in the market. So if you are looking at the market, how are you seeing it? Are you perceiving it based on fear or are you perceiving it based on logic and the parameters around what you need to do to get to your goals and to achieve what you want to do? So, on that note, make sure that you have a strategy. Make sure you understand what risk is, whether it be FOMO, whether it be the outer market, whether it be the inner market. Most people fear risk. Most people are fearing risk as interest rates going up. Most people are fearing risk because the news says that we're going to see a property crash, right? I see risk very differently. I see the risk that some 100 people in the open home push the fucking price up for me to have to pay for that property. I see risk that it's never been so high beforehand and it could fall from that top level. I see risk, from every different aspect in the market. And I analyze that risk and I assess that risk based on what my personal goals are and my personal position. I see that for all of our investors as well. So if you are interested in kicking ass in this sort of time in the cycle, reach out to us. If you are unsure of where to start off with, you can reach out to us. If you want to get started, you can reach out to us. If you've made a few decisions that aren't the smartest, reach out to us. Maybe we can help you. Maybe we can put you in the right track. Make sure that you're making logical decisions. Make sure you have a sound, solid investment plan that you're working along with achieving. and make sure that you don't get caught up in hype, whether it be hype is in positivity or hype in negativity. I think 90% or maybe let's say 80% of the market get caught up in either, wow, let's go buy that thing, the market's going up, right? Or people go, oh no, the market's going to go down and blah, blah, blah. They get brainwashed from the media that's out there. Make logical, educated decisions, guys. If you need help, reach out to us, 1300 367 925. Email us at admin@binvested.com.au. Make sure you subscribe to us here. We're on YouTube, Google Play, Spotify and Apple Play. You can catch up with us every Tuesday. We'll keep the podcast coming. Catch up soon. Have a great day. Bye for now.
Like Bilal said, man, we're stuck in the matrix. This my advice, don't care if you take it. The dollar back to die, soon to be hyperinflated. This my 2 cents, don't care if you save it. Join be decentralized and you will see you been lied to the whole time, and it's the irony, cause they do the exact opposite. You become a slave to the system, enough your money, all they do is profit. There's no conspiracy theory, you better hear me. Crypto will set you free before the system does. I don't care if you do or you don't, but what I'm saying is the truth to the reason you choke. I never been a failure, excuse my behavior. Keep talking, haters doing me a favor. They all tell lies, I know what they been telling you. I'm the opposite, the Donald Trump of Australia. It's amazing, there for the taking. My time is never wasted, just getting wasted.